Welcome to the deep dive. We are immediately peeling back the layers on, well, one of the most intellectually challenging and contradictory market environments we've seen in years.
Yeah, it really is something.
We are standing right on what feels like a critical inflection point,
Yeah.
wrestling with this staggering question that just defines the current market climate. How is it possible that corporate profits are not just strong, but are actually soaring to near record levels? Yet the overall market sentiment, particularly among consumers, has collapsed into the absolute gutter.
It is quite simply the great disconnect, as you said.
Yeah.
And understanding the fault lines of this divergence is absolutely mission critical for navigating the week ahead.
Possibly.
The intense volatility we saw leading into this week, November 10th through the 14th, it wasn't random noise. It was a battle between fundamentally powerful corporate realities and this paralyzing macro sentiment. That conflict sets us up for a high-stakes breakout move. The only problem is, well, we don't yet know whether it will be to the upside or the downside. We really have to analyze our sources, connect those micro pain points to the macro paralysis to try and forecast the market's probable direction.
And when you look at the source material, the recent sell-off isn't attributable to just one single cause, is it? It really felt like a perfect storm created by three distinct, almost toxic drivers that converged simultaneously.
Precisely. Those three drivers, they're the whole story of the past week, and really the setup for the next. The first was a sudden, necessary, and pretty severe recalibration of multiples, especially within those high-flying AI and tech stocks. Investors stopped asking, is this growth real? And started asking, is this price reasonable given the whole interest rate environment? Big shift.
Yeah, that reasonableness factor. And the second factor, the macro killer, is the record-long U.S. government shutdown. We're at, 38 days and counting?
Still going?
It's created this massive data vacuum at the very moment the Federal Reserve needs. Like perfect visibility. The Fed is flying blind, and the market absolutely detests uncertainty, especially when it comes to rates.
And finally, because there was no official data, no jobs numbers, no trusted CPI, the market just seized on every single piece of negative private sector information available, like a sponge.
Right.
We saw sentiment surveys, layoff reports, all amplified far beyond what the, strong corporate fundamentals would suggest. It created this kind of emotional floor for the market ceiling, if that makes sense.
It does. Okay, Let's unpack this whole setup and let's dive into the week that just was, focusing on that really painful performance in the tech sector.
Yeah, that speed bump was real, wasn't it? And the source material confirms it was almost entirely located in the epicenter of the market, technology. After enjoying three consecutive weeks of pretty decisive winning, all three major indices decisively snapped their winning streaks for the week ending November 7th, 2025. And the performance data for the week. It shows exactly where the stress concentrated. While the overall S&P 500 fell, relatively modest, 1.6%, and the Dow Jones was down 1.2%. The real pain index belongs squarely to technology. The Nasdaq Composite plunged 3.0% for the week.
Wow, 3%.
Yeah. That performance marks its single worst weekly showing since that volatile period back in early April this year.
So that magnitude of movement really confirms that the market's overall direction was, once again, pretty much determined by tech stocks.
Yeah.
What was the mechanism behind that sharp, sudden decline? Was it something specific?
Well, it wasn't a profit warning or some kind of systemic failure, not really. It was driven by a necessary wave of profit-taking combined with what analysts are accurately calling a recalibration of multiples.
That phrase again.
Exactly. Because for most of 2025, the AI-led boom inflated valuations to levels that, frankly, bordered on speculative exuberance. The simple reality is that investors started questioning those lofty valuations. They looked at forward earnings estimates and realized the prices, in terms of price-to-earnings ratios, required basically flawless execution for years to come. And that calculus is just unsustainable, especially when macro uncertainty spikes like it has.
And we saw specific high-profile casualties that illustrate this point perfectly, didn't we?
We did.
Mega cap Alphabet, GOGL, fell 2.1% as investors realized its AI promise was already, maybe, heavily priced in. But the true barometer of the AI frenzy, chipmaker NVIDIA, NVDA, it plunged over 9% on the week.
Over 9%. Yeah, a 9% weekly drop in a market leader like NVIDIA is a serious indicator. It tells you that the momentum trade is taking a profound and likely extended break. It's paused.
What's fascinating about this moment and what you're saying signals a fundamental shift in the investing environment, is that market sentiment seems to have undergone this critical regime change. For most of the past year, the prevailing mantra was almost reckless: growth at any price.
Right. People are willing to pay almost anything.
Investors were willing to pay 40x, 50x, even 100x earnings for companies just hinting at AI dominance. Now you're saying the market is aggressively demanding growth at a reasonable price.
Growth at a reasonable price. That word reasonable is where all the friction lives right now.
And we saw this friction demonstrated by a clear, negative, sell the news reaction to corporate reports that were fundamentally actually excellent.
Absolutely. You look at a company like Palantir, PLTR,
Okay.
they posted a strong beat on earnings and, crucially, raised their revenue guidance, a classic beat and raise quarter.
Which normally sends a stock soaring.
Exactly. Traditionally, that's a guarantee the stock will soar, yet it sold off sharply immediately after the news. Similarly, Qualcomm, QCOM, delivered an upbeat forecast specifically tied to future smartphone chips, and they dropped too. The news was good, but the market reaction was punitive.
So this buy the rumor, sell the news behavior, it really suggests the easy money in that primary sort of straightforward AI momentum trade is definitively over.
I think that's fair to say, yes. The street is signaling that flawless execution and aggressive optimism, they're no longer enough. They are already priced into these stretched valuations, even after the recent pullback.
So this raises the stakes immensely for the upcoming wave of tech earnings, especially the big large cap names, right?
Oh, absolutely. A simple beat on past earnings won't cut it anymore. To justify their current elevated multiples, which are still high, let's be clear, even after the pullback, companies need to provide exceptionally strong forward guidance.
What does that look like?
Well, that guidance must detail accelerating revenues, clear monetization paths for these AI products everyone's talking about, and, crucially, defensible margins. If the guidance is merely in line with expectations, the market will likely treat it as a disappointment. The bar is much higher now.
And this nervousness, it's clearly showing up in the underlying mechanics of the market too, right? The market internals are deteriorating. We are seeing a worrying decline in market breadth. Fewer and fewer stocks are actually participating in these recent rally attempts. This points directly to the risk of what our sources are calling historic market concentration.
That concentration is a genuine systemic risk. It really merits a deeper look, actually. Historically, when you see a handful of stocks dominating the index to this degree, it often precedes periods of high volatility or even structural correction.
And the numbers are pretty stark.
They are. We're talking about the top 10 stocks now accounting for over 40% of the S&P 500's total market capitalization.
Over 40%.
Yeah. To put that in perspective, that level of concentration rivals the height of the dot-com bubble back in 2000.
So why is that concentration percentage, 40%, held by just 10 companies? Why is that so dangerous for the average investor, maybe someone holding an S&P 500 ETF?
Well, because of the profound impact it has on passive investing, which is how most people invest today, right? Through index ETFs or mutual funds tracking the S&P 500. When 40% of the index's weight is tied up in just 10 companies, the performance of those 10 companies essentially becomes the performance of the entire market.
Right, they drag everything with them.
Exactly. If one of those giants experiences a significant pullback, say 10% on a missed forecast, it drags the entire S&P 500 down disproportionately. Even if the other 490 stocks are doing okay or even well, it creates this enormous correlation risk. The entire market rises and falls on the same handful of reports, increasing systemic fragility.
And we see that fragility reflected perfectly in the volatility measure. The SIBO volatility index, the VIX, the market's traditional fear index, it jumped a staggering 25% last week, closing at a two-week high of 21.82. That metric tells you that institutional investors are paying significantly more to hedge their portfolios, reflecting deep anxiety about the direction of those highly concentrated mega caps, doesn't it?
It absolutely does. They're buying protection because they see the risk tied to that concentration.
Okay, so that micro volatility in the tech sector is then amplified exponentially by the central macro problem plaguing the entire economic picture, this profound data vacuum. We shift from the specific stock pain to the general policy paralysis caused by the record-long government shutdown, now in its 38th day.
38th day, yeah.
When you have the economy's policymakers deprived of their essential inputs, it's not just an inconvenience, right? It fundamentally blinds them.
It's the perfect storm of uncertainty. The government shutdown means critical reports are simply not being released. We are missing core labor market data, like the monthly employment report, NFP, and the Jyoti's job opening survey.
Key numbers.
Crucial numbers. We are also missing vital inflation indicators. This is why the analogy is so apt. The Federal Reserve is now essentially driving in the fog, or maybe more accurately, groping around in the dark.
Yeah.
The central bank relies heavily on employment and inflation data to manage its dual mandate, price stability and maximum employment, and those reports have effectively vanished.
What's truly remarkable, though, is the policy collision this has created. Just last week, remember, before the full weight of the shutdown really hit, Fed Chair Powell delivered a notably more hawkish message.
He did, surprisingly so to some.
He was signaling that the Fed was ready to maintain a restrictive stance for longer, casting serious doubt on any near-term rate cuts, including the previously anticipated December cut.
But the market, in this, well, stunning display of defiance, effectively ignored that hawkish message, just tuned it out.
Really?
Yeah. Instead of listening to Powell's words, Wall Street traded entirely on the emerging weakness confirmed by the private sector data. Traders are increasingly confident that the Fed will cut interest rates for a third time this year, next month, in December.
So the market is betting against the Fed's own words.
The market is betting against the Fed's verbal guidance and for a forced data-driven pivot. A pivot prompted by those terrible private sector sentiment reports we're going to discuss shortly. They think the data will force the Fed's hand.
Okay, so if the market believes economic weakness is emerging, why would the Fed cut based on less data? Doesn't driving in the fog, as you put it, suggest they would hold steady, maybe fearing they'd make a mistake?
That's the core of the policy trap they find themselves in. While caution usually favors a pause, you're right, the current environment is unique. The Fed is mandated to maintain price stability and maximum employment.
The dual mandate.
Exactly. If the only data they have, these private reports, are screaming that the economy is falling off a cliff, then maintaining a hawkish stance without official confirmation risks inducing a severe, unnecessary recession. The absence of official employment data makes a Fed exceptionally sensitive to downside economic risks right now.
And the biggest single source of uncertainty for the immediate future, it seems, is the October Consumer Price Index, or CPI. That was scheduled for November 13th. Our sources indicate this report is now highly likely to be delayed or potentially canceled altogether. This sounds like a logistical crisis, almost like a CPI uncertainty principle in action.
It is. The problem is fundamentally logistical, but the implications are methodological and, frankly, massive. Roughly 2/3 of the price data that feeds the core CPI measure, the data the Fed relies on most for inflation, is collected manually.
Manually?
Yes, by Bureau of Labor Statistics, BLS, field agents. These agents actually visit specific brick-and-mortar locations to verify prices for goods and services. Since those workers are furloughed due to the shutdown, the data simply cannot be gathered properly or comprehensively.
So the resulting data might be canceled altogether, meaning we just lose the October reading entirely. Or, you mentioned potentially worse, the BLS might resort to imputed data. What exactly does imputing mean in this context, and why does it jeopardize the quality of the report so profoundly?
Okay, so imputing means they don't actually have the measurement for a specific item or service. Instead, they use complex statistical modeling to basically guess what the price change should have been.
Yes, that doesn't sound reliable for the Fed.
Well, they might use the price change observed in the areas where data was collected, like maybe automated energy data, and apply that pattern to the missing categories, say apparel or medical services. Or they might simply carry forward the previous month's price change for that item. Now, imputation is a standard tool used to fill small gaps. That's normal.
Okay.
But when potentially 2/3 of the data is imputed, the resulting index figure is no longer a true measure of current inflation. It becomes, frankly, a dangerous fiction for the Fed to rely on.
And how do markets react to that?
Bond traders, who are extremely sensitive to methodological purity, they'll immediately distrust such a reading. They'll trade off alternative, less comprehensive data sets like the Producer Price Index, the PPI, which we'll get to. The imputed CPI would likely be ignored.
This methodological compromise then creates that policy trap we mentioned earlier.
Yeah.
If the CPI is missed or rendered untrustworthy, the Federal Reserve could go into its crucial December 10th meeting with critically limited visibility on 2 full months of inflation and employment data.
Exactly. This is the moment when the lack of data itself becomes a driver of policy. If the private data, those terrible sentiment figures and layoff reports, suggest deep economic slowing, the Fed's traditional risk management approach suggests they should lean toward accommodation, maybe a cut or a pause, rather than risk accelerating a slowdown they can't accurately measure.
So the absence of official reports gives immense, almost disproportionate power to the grim narrative coming from the private sector.
That's precisely it. The vacuum gets filled, and right now it's being filled with negative signals.
Now we arrive at the absolute heart of the conflict, the great disconnect. We've got policy paralysis because of the data vacuum, amplified by the AI valuation shock, and all this turbulence is set against this incredible divergence between investor mood and actual corporate performance. This feels like the most crucial part of our deep dive.
It is the paradox. It encapsulates the entire current market challenge. With official government data absent, the market fixated entirely on those private reports we mentioned, and they were, in the analysis of our sources, uniformly negative, just bleak.
Okay, let's start with the mood of the consumer. The University of Michigan's preliminary November sentiment survey plunged dramatically. But the truly arresting statistic, the one that jumps off the page, is the component measuring current economic conditions. That fell to the lowest level recorded in the survey's 73-year history.
73 years. Let that sink in.
73 years. Let's put that in context. That survey began back in 1952. So this reading is lower than during the absolute depths of the 2008 financial crisis, lower than the stagflation nightmare of the 1970s, lower than the harsh recessions of the early 1980s. That isn't just a survey data point. It feels like a profound psychological low point for the American consumer.
It really does. And our sources say that collapse was directly attributed to consumer concerns over the economic effects and, frankly, the political dysfunction of this prolonged shutdown.
People are just fed up and worried.
Exactly. Consumers are deeply worried about their jobs, their financial prospects, and that anxiety is like a ticking time bomb for future spending. Compounding that is the labor market weakness indicated by that private data. The report from Challenger, Gray and Christmas showed that October job cuts were the highest for that specific month in over 2 decades.
2 decades.
Specifically since 2003. So, the narrative coming from the private sector is crystal clear. Main Street feels terrible, believes the economy is slowing rapidly, and businesses are aggressively, maybe preemptively, laying people off.
But this is where the contradiction just hits you over the head, because the market is absolutely not selling off due to deteriorating fundamentals, is it? Corporate America is, by the numbers, absolutely crushing it. How can the consumer feel this poor while the corporate bottom line is this strong? It doesn't seem to add up.
That is the ultimate test, isn't it? Behavioral economics versus financial reality. The bullish counter-narrative, drawn directly from Q3 earnings reports, is fundamentally powerful. The earnings season, now over 90% complete, has been exceptionally strong.
Tell us the numbers.
Look at the hard figures. 82% of S&P 500 companies beat bottom-line earnings estimates. That's significantly above the 5-year average of 78%.
So companies are outperforming expectations.
Considerably. And this isn't merely about companies managing expectations lower so they can beat them. It's about genuine aggregate growth. The S&P 500 is currently on track for a whopping 12% aggregate earnings growth year over year.
12% growth.
That marks the 4th straight quarter of double-digit year-over-year gains. Even the technology sector, despite that recent sell-off we discussed, posted an impressive 22% growth.
22% in tech.
Yeah. The Magnificent Seven names, even after that valuation recalibration, are still delivering exceptional performance and, importantly, raising future guidance. This confirms that corporate fundamentals, things like innovation, operational efficiency, global demand for new tech like AI, are providing a powerful, durable support. It's establishing a solid floor for the market.
So we have this market floor set by 12% earnings growth, and then a ceiling created by a 73-year low in consumer sentiment and this paralyzing data vacuum. Why is the consumer reacting so severely to the shutdown and the political noise rather than maybe celebrating the financial reality of still relatively strong employment and soaring corporate profits?
Yeah, it's a great question. I think it boils down to behavioral factors and loss aversion. The average American worker is probably more attuned to political chaos, high-profile corporate layoff announcements, even if they are concentrated in specific industries like tech and the generalized media narrative of gloom.
Than abstract earnings reports.
Exactly. More than abstract, aggregated S&P 500 earnings growth figures. And loss aversion dictates that the pain of a potential loss, like losing your job security or facing a recession, is felt far more acutely, maybe twice as much, as the pleasure of an equivalent gain, like seeing your 401k go up a bit.
That makes sense. The fear is stronger.
Right. The 38-day shutdown isn't just an economic event. It's seen as a failure of governance that translates into profound insecurity for many people. And this behavioral ceiling is what's forcing the Fed to seriously consider rate cuts, even though the underlying corporate data doesn't yet scream recession.
Okay, this profound conflict fundamentals versus sentiment brings us directly to the technical picture, which sounds just as volatile and critical as the macro dilemma. The market is positioned at a technical inflection point, which makes the next few days absolutely crucial for establishing the directional move, maybe for the rest of the year.
That's right. The technical battleground is centered squarely on the S&P 500's 50-day simple moving average, the 50-day SMA, that currently sits right around the 6,680 level.
And why does this specific moving average, the 50-day, hold such massive psychological power for institutional traders?
Well, because it represents the average closing price over the last 50 trading days, roughly 2 months, it's become the most critical benchmark for confirming near-term trend health. If the S&P 500 is trading above it, the trend is generally viewed as positive, buyers are seen as dominant. If it dips below, it signals weakness and often encourages short sellers.
Okay.
The significance is multiplied exponentially here because the index had traded above this average for 133 consecutive sessions.
133 days.
Yeah, that is the longest streak since way back before the global financial crisis in 2007. Breaking a streak of that duration is a massive, attention-grabbing signal that the market character has fundamentally changed. People notice.
And on Friday, we saw the definitive test of that anchor. Describe that Friday reversal because it sounds like high drama for traders watching it live.
Oh, it was pure market theater. The index briefly dipped below that critical 50-day SMA line, which is often the immediate signal for institutional sell programs to kick in automatically.
Right, the algorithms fire.
Exactly, but then, almost immediately, really aggressive buy the dip money poured in, staging what analysts called the biggest intraday turnaround since April. The index managed to claw its way back and, crucially, close above the 50-day SMA at the end of the day.
Wow.
That aggressive defense shows that buyers still have deep conviction in the fundamental strength we talked about, but they are fighting for their lives against this pervasive macro anxiety. It's a real battle.
So based on the source material, we have two very clear and immediate scenarios for the week ahead, both tied directly to whether we hold this 6,680 line on the S&P 500.
That's right. The bullish scenario requires the S&P 500 to establish support at, or ideally, above 6,680. That means trading confidently above it for multiple sessions, not just bouncing off it.
Okay, consolidation above it.
Exactly. If it does that, that defense will embolden dip buying behavior. It acts as confirmation that the underlying corporate strength outweighs the macro fog. And that validation, that signal, will likely pull significant amounts of sideline capital back into the market from investors waiting for clarity.
And the alternative, the bearish signal. What happens if it fails?
Well, if the index does not hold up at the 50-day SMA, if it slides convincingly below 6,680 early in the week and stays there, it signals that the negative macro sentiment and that lingering AI valuation shock have finally overpowered the buyers.
Game over for the bulls, short term.
Short term, yeah. That would confirm the intermediate-term downtrend is likely resuming, probably leading to a deeper correction, potentially testing the October opening level around 6,641 or even lower.
Now, overlaying this crucial technical test is a unique complication, a calendar quirk that could really distort the battle. The Veterans Day liquidity trap on Tuesday, November 11th. This sounds vital for our listener to understand if they're trading or watching closely.
It is. This is a textbook example of a structural market anomaly that can catch people off guard. On Tuesday, the U.S. stock market, both the NYSE and NASDAQ, will be fully open for normal trading hours.
Okay, stocks trade.
Stocks trade. Crucially, however, the U.S. bond market will be closed in observance of the federal holiday.
Why does a closed bond market matter so profoundly to stock traders? What's the structural connection there?
Because the bond market, specifically U.S. Treasury yields, provides the essential risk-free benchmark for all equity valuation. Treasury yields are the primary input used in basically every financial model to determine the present value of future corporate cash flows.
A discount rate.
Exactly. It's the constant input used by algorithms and human traders alike to gauge risk appetite in real time. When that benchmark, the anchor of all valuation, is frozen for the day because the bond market is closed, stock traders have no real-time signal to gauge changing interest rate expectations or shifting risk tolerance based on bond market moves.
So essentially, Tuesday becomes this kind of black box day, where any big stock move isn't necessarily based on fresh fundamental shifts or real yield comparisons, but maybe just pure low-volume speculation or noise.
That's a great way to put it, black box day. It makes the Veterans Day trap a significant risk for anyone trying to, say, front-run the 50-day SMA test based on Tuesday's action alone. And compounding the confusion, a significant portion of cross-asset traders and sophisticated institutions who typically provide a lot of the market's volume will likely be offline, maybe traveling for the long weekend or just using the day to catch up administratively. This guarantees significantly lower overall market liquidity on Tuesday.
Lower volume means bigger swings on less news.
Precisely. So the warning to the listener is critical. Any market-moving news, whether that's a new headline on the shutdown talks, an unconfirmed rumor floating around, or even a scheduled earnings report, like Occidental Petroleum's, OXY, which is due on Tuesday, could cause exaggerated outsized price moves on that thin volume.
Which means Tuesday's price action could very easily be a fake out. It might briefly break the 50-day SMA on low volume, maybe trigger some stops, and give a completely false technical signal to longer-term trend followers.
Exactly right. Tuesday's volatility and the associated price action could be entirely unreliable for determining the true technical trend. The real test for the S&P 500's crucial 50-day SMA battle will likely only come on Wednesday through Friday. That's when the bond traders return, real liquidity normalizes, and we get the context of real-time Treasury yields again.
So patience is key, especially on Tuesday. Don't get faked out.
Patience and skepticism about Tuesday's moves, absolutely. Okay, so given the near certainty that the official October CPI is going to be delayed or significantly compromised, all focus shifts dramatically to the mission-critical data scheduled for the end of the week, Friday, November 14th. These reports are really the only chance we have in the near term to get an official read, to confirm whether the market's bearish sentiment is justified by hard data or whether it's largely based on political chaos and that sentiment plunge.
Right, the reality check. First up on Friday morning is the Producer Price Index, or PPI. Why does this wholesale inflation measure suddenly become so indispensable this month?
Well, if the CPI is indeed missed or unusable, the PPI, which measures the prices companies pay for their inputs, things like raw materials and intermediate goods, becomes the only official inflation read we have for the entire month of October.
The only one. Wow.
Yeah. Consensus expects the year-over-year figure to cool slightly, landing at plus 2.6%. Now, the PPI is often seen as a leading indicator for consumer inflation down the road. So a soft number, something below that 2.6% consensus, would provide some relief. It would confirm inflation is cooling at the wholesale level.
And the market reaction.
That kind of soft print would likely pressure the dollar, rally bonds, when they reopen on Wednesday, of course, and crucially for equity markets, it would effectively lock in December rate cut bets by validating the market's belief that the Fed has room to pivot, that inflation is heading the right way.
But the number everyone is probably watching closest, especially given that staggering 73-year low in consumer sentiment we keep coming back to, has to be retail sales, right?
Oh, arguably the most important data point of the entire week. Retail sales for October gives us the first official quantitative look at Q4 consumer health. Remember, consensus is currently projecting a pretty weak plus 0.2% month-over-month gain.
Only 0.2%.
Yeah, that figure represents a sharp slowdown from the plus 0.6% pace we saw back in September. And given the staggering collapse in consumer confidence, that 73-year low we discussed, the downside risk to this number feels immense. What if consumers really did slam the brakes in October?
Okay, so what are the volatility scenarios if we get a flat, or even worse, a negative retail sales print on Friday? How does the market possibly react?
A flat or negative reading confirms that the economy is indeed hitting that air pocket suggested by the sentiment data. The market reaction will be intensely volatile, almost certainly, presenting a classic immediate market dilemma.
Dilemma how?
Well, scenario one, it could spark a vicious bad news is bad news sell-off. In this case, investors finally realize the economic stall is real, recession risks genuinely rise, and that fear overpowers the hope of a Fed cut.
Okay, reality bites.
Right. Scenario two. It could trigger a massive bad news is good news rally based entirely on the market, cementing its belief that a December Fed rate cut is now an absolute certainty because the economy clearly needs help.
So the market cheers the bad news because it means cheaper money.
Exactly. Traders will have mere seconds to decide which narrative dominates. The trading environment on Friday morning, right after that 8:30 a.m. Eastern release, will likely be fast, decisive, and highly unpredictable. Whiplash is possible.
Definitely one to watch closely. Now, beyond the macro data, the week also features some high-stakes earnings reports that will serve as immediate tests of that new skeptical sentiment regime we talked about in part 1, where a simple beat just isn't enough anymore. Forward guidance is the essential metric.
That's right. We begin with a major networking bellwether, Cisco, symbol CSCO, reporting Wednesday after the market close. Cisco is a crucial checkpoint for overall enterprise IT spending.
What's the focus there?
The market will focus entirely on enterprise AI networking orders. Are companies actually buying the gear needed for AI? And also on the progression of their backlog, how much future business is lined up. They also really need to provide clear synergy updates from that massive Splunk acquisition they made. Investors need justification for that big deal, especially now.
Okay, then on Thursday morning before the market opens, we get Walt Disney, DIS. That's a key media, entertainment, and importantly, consumer bellwether. After that sentiment collapse, the focus on the consumer-facing businesses must be intense.
Oh, absolutely intense. For Disney, the analysis really breaks down into 3 core areas. First, the crucial path to profitability for their direct-to-consumer streaming segment, Disney Plus-led. Wall Street is tired of the losses there. They want to see black ink.
Right.
Second, the strategic roadmap for ESPN and the new ESPN Bet initiatives. How are they navigating the sports landscape? Third, and perhaps most sensitive, given the consumer anxiety we've discussed, any signs of slowing momentum at their high-margin parks division.
The theme park.
Exactly. The parks have been an absolute earnings powerhouse for them post-pandemic. Any indication that the average American family is pulling back on discretionary travel, maybe delaying that Disney trip, will be seen as a direct confirmation of that 73-year low sentiment reading. It would be a very tangible signal.
Also on Thursday, but after the close, we have Applied Materials, AMAT, a major semiconductor capital equipment bellwether. They sit right in the middle of the global AI hardware build-out, making them crucial.
Hugely important. The bull case for AMAT relies entirely on continued strong capital expenditure demand for both AI chip manufacturing and advanced memory production. But the crucial watch item, the thing that introduces the geopolitical dimension, will be their guidance regarding the impact of China export license headwinds.
Oh, the restrictions.
Yeah, that uncertainty has been a consistent risk factor hanging over the entire semiconductor space, and the market desperately needs clarity on how those U.S. restrictions are translating into tangible order cancellations or delays from Chinese customers. ANET's perspective is vital there.
And finally, we have 2 crucial check-ins on the health of the Chinese consumer and tech sector, with JD.com reporting, I think, Wednesday morning, and Alibaba, BIE, on Thursday morning.
That's right. These act as important proxies for the health of the world's second-largest economy, which has its own set of challenges right now. For JD.com, the focus will likely be on retail margins and profitability in what's become a fiercely competitive e-commerce environment over there.
And for Alibaba?
For Alibaba, the street needs to see continued strong growth in their cloud intelligence segment, that's key, and also solid progress on their own AI monetization initiatives. This is especially important as their traditional e-commerce business matures and faces more intense domestic competition. So cloud and AI are the focus for Baba. So, okay, let's try and summarize this deeply contradictory environment we've been dissecting. The long-term fundamentals, driven by that exceptional Q3 earnings season and the durable multi-year AI technology theme, they remain powerfully intact. That establishes, I think, a robust floor for the market, fundamentally speaking.
Right. The corporate side looks solid.
However, the near-term picture is utterly dominated by that critical 50-day SMA technical test we discussed, and the severe macro data gap amplified by that shocking 73-year low in consumer sentiment. This dynamic creates the volatility, the uncertainty, and the effective ceiling that the market just cannot seem to break through yet.
So, based on that, we should probably conclude that last week's pullback, especially in tech, wasn't really a sign of fundamental collapse, but rather a necessary, maybe even healthy rotation. The sharp AI sell-off exposed the serious structural risk associated with that historic market concentration, where just 10 stocks drove nearly half of the market's value.
Absolutely. I think healthy rotation is the right way to frame it. That capital didn't just vanish from the system. It is now actively looking for new, potentially more attractively priced leadership outside of that mega cap concentration bubble.
So money is moving.
Money is moving, looking for a new home. This is the classic signal that investors need to rapidly diversify their exposure away from that handful of names that have concentrated so much of the risk and also so much of the recent volatility.
Okay, that leads directly then to the concrete strategic recommendations for listeners trying to navigate this highly contradictory, maybe confusing environment. First, Portfolio Management 101, prioritize diversification.
Correct. The primary recommendation coming from our sources is to maintain portfolio balance and aggressively diversify. Analysts strongly advise avoiding overexposure, meaning, don't let 30% or 40% of your portfolio sit in that handful of mega cap tech names that have proven to be the primary source of recent market swings. Use this rotation as a chance to rebalance, take some profits perhaps.
So broadening exposure is the key. You mentioned specific sectors earlier that analysts are highlighting as potential beneficiaries of this rotation. Why industrials, consumer discretionary, and healthcare, why are they the recommended landing spots now that the easy money in the primary AI trade seems to be cooling? Shouldn't money just rotate into maybe other second-tier AI infrastructure plays?
That's a critical question and a challenge. While further AI infrastructure plays will likely benefit long-term, investors right now seem to be looking for established value and maybe some insulation from these immediate macro risks and uncertainties.
Okay, a bit more safety.
A bit more perceived safety, perhaps. Industrials are attractive because they often benefit from broad-based infrastructure spending, some of which is non-AI related, offering potentially more predictable cash flows and generally lower valuations than pure tech right now. Healthcare is, of course, the traditional defensive value play. It tends to be less susceptible to economic downturns and boasts typically robust balance sheets.
Okay, industrials and healthcare make sense. But consumer discretionary? That seems counterintuitive given the 73-year low in consumer sentiment we keep talking about. Why that sector?
Yeah, it seems odd on the surface. The argument here is somewhat tactical. It's that the sector has been hammered because of that terrible sentiment. But if the market starts betting heavily on a Fed rate cut, that bad news is good news scenario we outlined for Friday.
Ah, the pivot play.
Exactly. Consumer discretionary is often one of the first cyclical sectors to rally hard on the expectation of future economic recovery, driven by lower rates, regardless of the current weak sales data. It's a tactical, recovery-oriented bet on a Fed pivot materializing.
Got it. It's a forward-looking bet. And finally, what's the ultimate tactical caution for the week of November 10th navigating all this?
I'd say remain intensely cautious and nimble until the market clearly resolves that 50-day SMA technical test. Don't chase weakness below it or strength above it until there's confirmation. And above all, be exceptionally wary of potentially misleading price action on Tuesday.
The Veterans Day trap.
Remember the Veterans Day liquidity trap due to the bond market closure? The true directional test really begins Wednesday, and the final crucial decision point looks like Friday's data deluge, PPI, and retail sales. #tag outro.
Okay. We have navigated the critical technical battle lines, the necessary AI valuation reset, and this profound macro data vacuum created by the ongoing government shutdown. When we look ahead to the end of the week, it really feels like the entire market hinges on Friday's mission-critical PPI and especially retail sales reports.
Absolutely. The market has clearly placed its bet firmly on a Fed cut. It is operating almost entirely on the hope or maybe the expectation that bad news is what forces the central bank's hand toward accommodation, toward easing policy.
So here is our final thought for you, the listener, to consider based on that massive disconnect we've explored. If Friday's retail sales not only disappoint, but actually confirm the story told by that 73-year low in consumer sentiment, confirming that the American consumer has truly pulled back spending in a meaningful way, will the market successfully rally on the certainty of a December rate cut, sticking to the bad news is good news playbook? Or will institutional buyers finally decide that truly bad news is just bad news? When the economic stall shifts from a sentiment reading to an official quantitative reality in the data.
Yeah, where's the breaking point?
Exactly. What level of slowdown will it take for the market to stop relying on the Fed, putting a floor under everything, and start genuinely fearing the state of the economy? What will you be watching for when that volatile data drops on Friday morning?
That is the disconnect we will keep tracking right here. And that is what makes this moment such a fascinating high-stakes trade for everyone involved.
We'll see you next time for the next Deep Dive.